Hello, everyone. My name is Stein. I am a co-founder at Carbon Collective, and today I want to talk to you about a topic that we talk about a lot. So at Carbon Collective, we do sustainable investing, and our goal is to make sustainable investing be smart investing, make it smart to invest sustainably. And about half the questions that we've gotten are about sustainable investing, but the other half that we get is just purely about smart investing. And so today I want to talk about that latter part. From Roth IRAs to rebalancing, let's go through how do you be a smart investor, and let's explain it simply. So what we're going to start with is why invest at all? And then if you're going to invest, why invest in stocks and bonds specifically? Why do people do that? And then how do you be a smart investor when it comes to stocks and bonds? With a hint coming up of it's not that hard. Then we're going to talk about how your investment should change over time, and then what tax-related accounts and things that you should know about. And finally, we'll walk through a series of financial planning scenarios. So about myself, here you see I've recently got a haircut and currently need one. My co-founder and I, we are old friends, and we set out at the beginning of 2020 to make it simple and safe to invest in portfolios that are built around solving climate change. And why do we do that? Because having somewhere to invest is really important. And so let's talk about why. Why do people invest at all? The first reason is that, let me move my face here, is that you can grow your savings without additional work. My face is too large. There we go. So this is the past 25 years of returns from the S&P 500. So beginning on August 13th, 1996 through August 13th of 2021. And as you can see, $100,000 invested at this time in 1996 would, on August 13th, 2021, would have been worth almost $1 million. So that's money put in there without anything else going on with it, no work needed for it. And that speaks to the power of compounding returns. When these returns, like in the stock market, they don't grow linearly. They actually get steeper the longer that you have them in there. They can compound and look more like an exponential. So when we look at this, if you assume, say, a rate of 5% annual return, $100,000 started out with in 40 years could be worth $700,000 at a rate of a 5% annual return. At a rate of 7.5% annual return, that $100,000 is $1.8 million, so over double. And then 10% would be far, far more at $4.5 million total. And so this is important because when we put away money, we're doing it so that we can comfortably and safely stop working and have enough. So I like to look at this, and we'll come back to this graph in a little bit later. But we look at someone like Chris. Chris invests $5,000 annually between the ages of 25 and 65, and in total he invests $200,000. That $200,000 over that period of time grew into over $1 million, which puts him in a strong position to say if he wants to stop working, that he can. So the flip side of that is if you don't invest, it's pretty hard to put your money in a place that you're going to beat inflation. Inflation happens. It is deliberate. If it didn't happen, the risk would be that people would actually hold on to money as an investment vehicle. If you knew that your $100 bill might be worth $110 in a few years, you're probably not going to take it to the store and use it. You're going to say, I'm going to hold on to this. And that kind of defeats the purpose of money. So instead, governments try to have their currencies inflate a little bit each year. So that way there's this little nudge of saying, hey, you should use this, because otherwise, it's just the value is going to go down. And so we can look at this is over the past 10 years. We know this in 2021, a lot of people are talking about inflation rates. The cumulative inflation rate over this time was 21.4%. So meaning of which that on average, a dollar could buy you 2.14% less stuff than it could in each of these years. And that's a pretty solid inflation rate. So I like to think about this in terms of burritos. When I gave this talk for the first time, I was informed that my burrito costs were pretty off here. This is at least in California, so I think there's a lot of variety in how much burritos cost in places. But I'm just going to speak personally. So I'm in California, and when I graduated from college in 2011, $100, that could get me about 11 burritos. A good burrito cost me about $9. Whereas now, in 2021, a good burrito costs something more like $12. And so that can get me only like 8 burritos. And that's just because the price of everything that goes into that burrito has gone up a little bit since then. The price of the food itself, the price of paying people to make it, the price of renting the building for it, the price of spatulas and electricity have all gone up a little bit. And so the problem with inflation when it comes to your money is if you just hold on to that $100 bill and you don't put it anywhere, its cost is going to go down. You're going to be able to buy fewer burritos than you could before. And there's not that great places to put it if you're just looking at banks. The highest rate of interest that you can get from banks is usually in what are called CDs. These are called certificates of deposit. And basically what you do is either for a 6-month, 1 year, or 5-year period, you go to a bank, you say, hey, I'm going to give you some cash. I'm not going to touch it. You're going to pay interest on that cash when that time expires. So in 6 months, 1 year, or 5 years. And looking over average CD rates, even a 5-year CD, which you can't touch that cash for 5 years without losing the interest or at least a very big penalty. So even that, over this entire period of time, has been under the rate of inflation over that period of time. So it makes a lot more sense, given that, to invest in something like the stock market, because over that period of time, we can look here from 1996 to 2021. The cumulative inflation rate was 74% over that time. Well, the stock market, the S&P 500, rose 981%. So even subtracting that 74%, you're still beating inflation by a fair amount. So that is why people invest. But now let's talk about why people invest in stocks and bonds. There's other things to invest in, things like houses, real estates, farmland, and things like that. Why do people invest in stocks and bonds in particular? So first, let's start out, what is a stock? A stock is a share of a company. So when you buy let's say a share of Apple, you own a percentage of that company. Here, when you buy a share of Acme, you own in this example 3 shares of Acme. And that gives you a few things as an owner of that stock. One, that company is likely to pay you dividends. When they make profits, they will pay dividends to their shareholders. And 2, they'll also seek your vote on key issues. Why a lot of people hold on to those stocks is that because overall, their value will tend to rise and fall based upon the expected performance of that stock in the future. So if the stock market or the other holders of these stocks and the people who want to buy these stocks, if they're like, wow, we see that this company is really going places and the dividends that we can make from that or from that growth is really going to be quite large when they get to that point, we want to make sure that we can have shares now and so the price will go up. So that's a stock. A bond is not ownership of a company. It is debt that a company issues. So let's say a company, Acme Co., is like, we want to build a new factory and we need the cash for that. And when we build that factory, we'll make a lot more money because we'll be able to sell the stuff we make in the factory. So they might raise the money using a bond. And they'll say, all right, you give us money now. So let's say $30,000 in this case. And that's just what you do. They'll probably raise much more than that. And then we'll pay you interest every year. So we'll send you a check every year, every half year based upon that until 10 years are up. And then at the end of the 10 years, we'll give you your money back. And so the initial $30,000. So it's kind of like a certificate of deposit, like what we covered earlier, but with much more scheduled interest rates. And it tends to be a lot higher. And the nice thing about bonds is that you get this set payoff. So they tend to have a higher reward than stocks, but also a much lower risk. So before we talk more about stocks and bonds, let's just dig into what makes something valuable. Like, let's zoom all the way back. The reason that things like Beanie Babies and gold and Bitcoin and this piece of paper with a guy's face on it, we see as valuable is just because we all agree it is valuable. There's a market for it of people buying and selling. That is it. That is what makes things valuable. We have come together and come to consensus as a civilization or series of civilizations coming together. And so that's it. And the more of us that agree that something is valuable, the more likely it is to be perceived that way. You know, you could look at something like the rise of Bitcoin or the fall of Beanie Babies. These things can really change over time. And so with stocks, the number one reason to invest in them is that they are perceived en masse as valuable. 55% of Americans owned stock in 2020, and that it was seen behind a house as the number one way to build long-term wealth. So there's this understood way that this is a way for you as an individual to invest. It allows investing in stocks and bonds, allows for easy diversification because you're not just investing like in a house in a single place, which could like flood or have a fire or something like that, but you're also investing in all these different companies from all around the US and the world. And so you're diversifying those outcomes. And those, same graphic here, those outcomes are tied to the overall economy. So you're kind of making this long-term bet that a lot of the systems we have in place, like our governments and stuff like that, which want the economy to continue growing, that you're kind of tying your investment to that as well. And the final thing, and this kind of speaks to why so many people own them, is that they have a really good track record. If you go back to 1871, and this is for the US stock markets, dollar invested would have increased by over 18,500 over that period of time, which is pretty nuts. There's a lot of people believe, because of this track record, we believe that this trend will continue, and that is part of actually what perpetuates it to continue, which is what makes it a good place to invest because of that really strong shared belief. So that's why I invest in stock and bonds. Now let's talk about the how. And this section is for you if you're like, I know I should invest. I want to invest in stock and bonds. I want something that can be hands-off, where I know I'm just making a smart move that I don't have to think about very much. And so let's go through the principles of it. The first thing is invest with the market. So don't try to beat the market, track the market instead. There are a lot of funds that are out there, mutual funds and ETFs, where the fund manager will roll up their sleeves and be like, all right, I'm going to try and beat the stock market. And they do all this research and they buy and sell a lot of stocks. And the thing is that this data is from S&P, is that if we look back over the past 5 years, 78% of those type of funds actually underperformed the overall stock market, or at least the S&P 500, which is the collection of the 500 largest stocks. And this data has actually been studied fairly well over the past decades, and there is a no greater likelihood than chance, if you're trying to find a fund that will beat the market, that it will in fact beat the market. Some will, but it's a normal distribution. So instead, track the market. So this is invest in the total market without picking winners, and go for as low fees as possible. And because you're investing with the market, there's not all that hard work with the sleeve rolling. And so fund managers don't charge nearly as much. And so that is just the best way to do it. So thing number one, invest with the market. What this enables you, because you're investing with the whole stock market, you're being exposed to all the different sectors in it. And so even if one sector is not doing well, other sectors might be. And so you're getting that balanced out and diversification. All right, thing number three, limit your exposure to non-diversified assets. So there could be things that are like really trendy, like this here, or even this here. And if you want to invest in them, like that's fine. But you shouldn't do it with more than 10% of what your total savings are. You should almost see it a little bit more like a hobby and what you're doing. And so long as you limit to that, that's great. You might make money, you might lose money, that's fine. Having a Robinhood account where you're individually trading stocks, if you're not doing this full time, that's totally fine. This next one, 4, is really important. Automating regular contributions. So timing the market is really hard. Right now we're in a stock, this is in August, the stock market is really, really high. And so you could be like, I'm going to try and time the market. I think it's going to go down. I should sell. The honest answer is we don't know. We don't know what's going to happen. We don't know if it goes down a lot, what might happen the next day. We just don't know. So the best and simplest strategy for people like you and me that are just trying to build wealth is to choose an amount that we invest weekly, monthly, quarterly, something like that, and just do it and set it and forget it. And let's look into why. So let's look at Boris here. Let's say that he bought a share. He had $400 to invest, and he bought 40 shares of this stock when it was at $10 per share. But then let's say the stock fell after that, and it ended up rising back to $10 a share. He still only has $400 worth or 40 shares. But Abby, she invested, she was going to do $100 a month. And so When she bought the first one, she got 10 shares, but she bought $100. She had $100 worth, but then the stock price fell. And so she got 20 shares. And then it fell even further. She actually got 50 shares. And then it bounced back. So for her, she actually ended up with a lot more because she wasn't trying to time the market. So this is a really important part. And it's a big part of why it's actually smarter to just set it and forget it when it comes to investing. Now let's talk about this graph again. So we're going to talk about this a little bit more later in the presentation as well. But it's really important to max your retirement savings, and especially in ways that are as tax efficient as possible. So we saw Chris, who was doing his $5,000, which is pretty close to the max, and how well that went for him. Now let's look at what happened with Susan. Susan invested $5,000 annually between the ages of 25 and 35, so just here. And then she sat on it. In total, she invested $50,000. So, okay, pretty good, about half of what Chris did in that point for a lot less investment. Whereas Bill, he invested $5,000 annually between 35 and 65. In total, he invested $150,000, and he actually ended up with the least, even though he put in far more than Susan. And it's because of the maxim, invest early and invest often. When the earlier you do it, the more time you give for those compounding returns. So as soon as you can be doing it, make sure you're maximizing your retirement investing. Next is to use a service that rebalances. So this is really important. Usually when you set an investment goal, you'll do some combination between stocks and bonds. Remember, stocks are the ones that have higher upside, that's higher risk, higher reward, whereas bonds are lower risk, lower reward. And so if you're saving for a long-term goal, like me, I'm 32, if I'm retiring in over 30 years, I can ride out fluctuations in the stock market. I want that high upside. So in that case, I'm going to be in something that's like more of a 90% stock, 10% bonds, or an 80% stock, 20% bonds. So let's say I choose this one for my retirement account. But let's say the market does really well over the next year. And that initially, what was 80%, those shares that I owned, they got bigger. And so they now take up 90% of my portfolio, and bonds are only 10%. So having something that will rebalance, either that's based upon time or based upon some type of trigger, is really important, because what it will enforce here is the old maxim of buy low, sell high. So here, a rebalancer will sell some of those extra stocks when they're high and then buy the extra bonds when they're low. And you'll bring back here. And the data shows that this generates much higher returns, plus it keeps you on target towards hitting your goals. Okay, next one is about keeping a safety net. So it's really important in just having a general financial plan that you want to have 6 to 9 months of money for your expenses that is set somewhere that is very liquid. So meaning that you could turn it into cash in a day or two. It's very conservative, so it's very unlikely to go down very, very much. And that it's not correlated with your main sources of income. So like, you don't want your safety net to be in the stock of the company that you work for. Because if that company goes out of business, then you've both lost your job and you've lost the stock you've lost your safety net. So that's really bad. So some good places for your safety net are high yield savings accounts. Right now, this is in August, the high yields on a high yield savings account is about 0.6%. So you're still well under inflation, but it's something. A money market account is similar to a high yield savings account, but it's on the open market. The yields for that are really low right now. Short-term government bonds can also be a really good option for this. The yields are also quite low at the moment. Or a Carbon Collective safety net account. We build something that is 15% stocks, 85% bonds, with the majority of it being short-term government bonds. That can be a really good option as a way to protect you against losses while giving you potential upside to beat inflation. So let's talk about what a simple contribution plan could be. So this is another way of how you can set your own rules for being financially smart and then just follow them. So let's say in a given month, you have an extra $2,500. So you get to the end of it, you've got your paychecks, etc. So for you, you've said, okay, for your checking account, which you use for daily expenses, you want to have a total of $5,000 in there. And let's say that it's down to $4,000. So you're like, all right, I'm going to top this up. I'm going to add another $1,000. Then you're like, all right, let me go to the next most critical thing, which is my safety net. And here you have $25K in your savings account and $25K in a Carbon Collective safety net account, because you want some of that with that upside of beating inflation. Here, let's say those are both met. So you actually don't need to put anything more in them. So you're like, all right, let me go on to the next thing. Here is you want to max your retirement. So you're going to put in $500 so that you can max your IRA contributions. And then you have some money left over. So you're just going to put it in a general brokerage account so it can invest in things like the stock market. So you could take advantage of those gains and have that money grow over time because you're not exactly sure what you want to do with it. And this is important, that as you get closer to needing the money, the more conservative you should get with it. And let's actually go and look at some numbers. So this is a blend. The green here we have is 90% stocks, 10% bonds, so a much more aggressive portfolio. Whereas the blue is 40% stocks and 60% bonds. So we can see as the green, it's unsurprising, over the past 25 years, did far better than the blue in terms of overall performance. But let's go and look back at 2008. If we had someone who was about to retire, let's say my parents, for example, if they had all of their money here in the green, so they were still in a pretty aggressive account, and let's say they were going to retire, they're like, I'm going to retire at the beginning of 2009. For them, if all of their wealth is in this, that portfolio could have dropped from almost up being 160% to at its lowest 36%. In 2008, it dropped, the green here dropped 33.5%. So it lost over a third of its value in that time. And it's really bad to sell when the market is at the bottom like that. That's where you're getting your worst value for it, because you're doing the opposite of buy low and sell high. Whereas if you were in this blue, the market would have gone down, but you would have actually been able to weather it. And so in general, it's not like you would have been in the blue here the whole time, but as you get closer to the time when you want to meet the money, shifting over into a portfolio that's more heavy in bonds is generally much smarter. Okay, and let's talk about the last thing here, is that when you leave your job, you should roll over your 401k. And there's a few reasons here. First is that 401ks tend to have really high fees. There's a lot of paperwork associated with them, and they'll happily keep charging it to you, even though they don't have to do the paperwork anymore after you leave your job. So here, this is pretty crazy. This 1% fee compared to if you just invested it in the S&P 500 over 40 years in lost returns would cost $714,000 in potential losses. That's crazy. The next thing is that your employer could change its 401k plans. And that can be a huge pain in the ass, because when they change a 401k plan, you're not having to go through multiple layers of HR to find where that money is your money that you put away. And the final thing is that 401ks are really limited in what they invest in. And so you can't invest in necessarily exactly what you want, things like ethically driven accounts and stuff like that. So that's really important. So let's go over those really quickly again, because I talked about a lot. Number 1, invest with the market. Number 2, it will diversify. 3, limit your exposure to non-diversified assets. 4, automate your regular contributions. Monthly is generally best. Max your retirement savings. Use a service that rebalances. Keep a safety net. Set up a simple contribution plan and follow it. When you get close to needing the money, move to more conservative. And finally, every time you leave a job, roll over your 401k into an IRA. Okay, it's a lot. We're getting there. We're almost there. Let's talk about taxes and investing and what you should know. Super high level. How do taxes impact investing? Let's say you bought a share for $100. One share of one company. The company does really well. And you're like, it's at $200. I'm going to sell. So you sell it. You make $200. This extra $100 that you got, that is called your capital gains. And at tax time, the government's like, I want a piece of that. And so generally the capital gains tax rate is around 20%. And so here you'd have to give away $20 of that. You have to give it to the government, and you get to keep 80. So still a good deal for you. You're still making money. And so that's how much you would owe. So there are ways of investing that are tax advantaged in different ways. And so I want to talk about those. And they all have to do with retirement. So there's a series of personal retirement plans and then employer sponsored plans. So let's go over it. The first is a traditional IRA. This is where you invest pre-tax dollars. So it lowers your taxes this year, and you pay taxes on the gains when you withdraw, but it's when you retire. So it's really long in the future or it can be very long in the future, depending upon who you are. There are contribution limits, so you can only put in $6,000 a year. This is in 2021. And if you or your spouse has a 401k or employer-sponsored plan at work, you may not be eligible. Let me go through a few notes here that apply to just a lot of these types of plans. You can't withdraw until you're 59 and a half without paying a penalty on it. So this is money that you're purposely putting away. The government's saying, hey, we're giving you this big tax advantage, but you don't get to take advantage of that and touch it early, or else we're going to take a big tax penalty from you. What's really nice about a traditional IRA is that you get to deduct, if you put in that full $6,000, you get to deduct that from your taxes. So if you're like, instead of making $100,000 a year, according to the government, you made $94,000 a year. So that's just, it could put you in a lower tax bracket, and then also mean you just have to pay fewer taxes because it sees your income as lower. So for an IRA, you do have to pay capital gains taxes when you withdraw, but you don't in between. So in a traditional investing account, when you're buying and selling things, you will have to pay capital gains on anything that you sell that has made money. Whereas if you do that in your IRA, you only have to pay capital gains at the very end. So you could buy and sell all the time with no immediate tax consequences. When you are 72, you do need to start taking minimum disbursements from any retirement account. And that is something that's you have to do by law, or else you'll get penalized. So let's talk about who a traditional IRA makes sense for. Generally, traditional IRA makes sense if your tax bracket is higher than you expect it will be in retirement. And also if you just would really use the extra cash today. So let's say here that I'm putting in $500 a month because I'm a smart investor. So that's going to be $6,000 total a year. And I expect my tax bracket of 25% is higher than it will be when I retire. So I do want to save for retirement. I know it's a really smart thing to do as an investor. I saw Chris's example and how $200,000 became over $1 million. And so, but getting this tax savings would be great. And so because I put in $6,000 and I'm in the 25% tax bracket, that's like I got a tax savings of like $1,500. And so it's like I am buying that stock for 75 cents on the dollar. It's a really good deal that you can get. A Roth IRA does the inverse. You instead are investing money that you've already paid income taxes on. So what happens there is that all of your savings grow tax-free, and there's no capital gains taxes on what you withdraw. There's a similar contribution limits, the same as a traditional IRA. So you have a lot of the same rules here. And that a Roth IRA traditionally makes sense if your tax bracket is lower than you expect it will be in retirement, and if you don't have a very high tax burden now. So let's talk about an example here. When Zach was working odd jobs in college, his tax bracket was lower than he expected it would be in retirement. Therefore, he invested in a Roth IRA so his savings could grow tax-free. So that's generally when it makes the most sense. There's a lot of variations to this, but a good way of thinking about when a traditional makes sense and when a Roth makes sense is if you're more closer to the prime earning part of your career in terms of income, and you don't expect to have a lot of income in retirement, then it generally makes sense to use a traditional. Versus if you're not at that point in your career, let's say you're at the beginning of it, then a Roth also could make a lot more sense. Now, a SEP IRA is like a 401k, which we'll cover in a sec, but it's for self-employed and small businesses. So here, the contribution limits are much, much higher. It's up to 25% of your net compensation with a ceiling of $58,000. So that's a big difference than $6,000. So let's go through some examples. So let's say Zach's spouse is a self-employed therapist who made $100,000 in net self-employment income this year. She wants to save for retirement while also getting some cash back from the government. So she could put in up to 25% of that $100,000. So she'll put in $25,000 times 25% her tax bracket. So that's $6,000 in tax saving, which again is buying stock for 75 cents on the dollar. Now let's talk about employer-sponsored plans. Employer-sponsored plans, if your employer is matching, is generally the best option. And let's go into why. Your contribution limit is much higher than an IRA. It's $19,500 per year. So that's pretty significant. You can lower your tax bracket or your tax rate a lot by doing that. It has a lot of the same rules. You can also do a traditional or a Roth 401k. And here, let's say that I work at a company that offers a 50% 401k contribution match. And this is the big difference with the 401k. A lot of companies will do this, and it's a huge benefit. So my 401k automatically gets deducted from my paycheck, and with his employer's match, he's investing 50 cents on the dollar. Now let's walk through how that works. So let's say Zach here or me am maxing out that contribution, so $19,500 per year. And the tax bracket that I'm in is 25%. I would pay 25% of that. So that tax savings, because I'm taking that off of what it looks like I'm paying to the government, or what my salary is, or my income was for the government, is $4,875. So that's like that 75 cents on the dollar. But let's say I'm getting a 50% match. So I'm getting all of that extra. So it actually rounds out to being more like I'm buying stock for 50 cents on the dollar, because this is money that my employer is putting in, and I don't have to pay taxes on that or anything. It's a really, really good deal. So now let's talk about Carbon Collective and how we do it. Our goal again was to make climate investing be smart investing. And so this is how we build our portfolios. Our goal in building them is that we want to be in a place to pressure the largest brands around climate change, so that we could push them to reduce, to switch to things like 100% renewable energy and 100% electric car fleet, because they are the ones that are most receptive to individual consumers and investors like us. And overall, helping us change this narrative that fossil fuels are actually a really poor investment with not much future ahead of them. So let's see how we do that. We start by looking at the overall stock market, because again, it is smart to invest with the market. We look at which sectors of the market are dependent upon fossil fuels. It's these four: utilities, materials, energy, and industrials. Their core business relies upon the long-term use of fossil fuels, and they're about 20% of the stock market. So we just cut them out and we invest broadly with the rest of the market, because these are the companies that, without changing their core businesses, could decarbonize. They could run without emissions. They could switch to 100% renewable energy, again, 100% electric fleet, etc. And this fully cuts out those companies that are dependent upon fossil fuels. We then take that extra 20% that we cut out and we give it to the companies that are building climate solutions. So not just solar and wind, but companies that are capturing methane from landfills, LED companies, companies that are building hydrogen infrastructure, companies that are expanding the grid, and many, many more. We then diversify with green bonds, which it's debt from companies to build renewable energy infrastructure, and then a range of US Treasury bonds. So overall, our most popular portfolio are 80% stock, 20% bond, our bold portfolio. 18% of it is in the climate index, so directly invest in those companies building climate solutions. 62% of it is in those low carbon sectors of the stock market that aren't dependent upon fossil fuels, so are going to be more open to pressure to change. And then a combination of green and government bonds. Overall, we like what we've built in that it's this combination of smart and sustainable, that it's diversified, it's inexpensive. You'll pay the same for an account with us as you would for a generic Wealthfront or a Betterment account, which are the two most prominent online investment advisors. And it's been historically market tracking, with, after the coronavirus crash, doing considerably better. So let's finish by talking about some scenarios of how you can set up your own contribution rules. So I want to walk you through a fictional family of mine and what would make sense for them in their current financial lives. So let's start with me. I'm 32 and I'm starting a family. So for me, I want to keep my checking account around $10,000. And then, at the end of the month, I'm going to top that up. Then I want to make sure my safety net is topped up. So in my high yield savings, I have $30,000, and then in my Carbon Collective safety net account, I have $40,000 for a total of 9 months safety net. Because I'm starting a family, I just want to have a little bit more in there. I then I want to make sure I max my IRA, so I put in $500 per month. I have it, because I'm not retiring for a while, I have it in my most bold, so the 90% stock, 10% bond option. I have an old IRA from back when I was younger, but I'm not contributing to it anymore because it doesn't make sense for me tax-wise at this point. And then I'm saving up for a house, so I use whatever is left at the end of the month. I put in a much more cautious portfolio at 50% stock, 50% bonds, because I do want to have that chance to grow, but I also want to protect, because I'm probably going to want to use this money in the next couple of years. I want to protect against significant losses in that time as well. Now let's talk about my fictional younger sister, Zoe Stein. So she is starting her career, and her daily expenses are a bit lower. She has $3,000. She wants to keep $3,000 in her checking account at the end of the month and also make sure that $3,000 is topped up in her savings. She then keeps 6 months of expenses for her at $30,000 in her safety net account. Because she's starting her career, her employer, they offer a 401k and it's 50% match. So she feels comfortable putting in $800 per month. I tell her to do more, but she's not going to listen to her older brother. It's at a 90% stock, 10% bonds, because again, she's probably not going to retire for something like 40 years. And then she's not sure what she wants to do with the extra money she has at the end of the month. So whatever is left over, she puts in a bold portfolio at Carbon Collective, which is an 80% stock, 20% bond portfolio. Now let's talk about my aunt, Zara Stein. She is 54 and is 11 years away from retirement. For her daily expenses, she wants to keep $15,000 in her checking account because a big expense might come. Maybe there's, something breaks in her house or something like that. She wants to be able to write that check to that repair person easily. And then for her safety net, she keeps $100,000 between her high yield savings account and her Carbon Collective safety net. For her, she's really pushing on retirement and saving as much as possible. So she is above 50, which means that for her, she can actually increase the amount that she can put towards retirement. And so for her, it could be $26,000 a year versus $19,500 for people under 50. So she maxes that because she's really smart and she's been with her employer for a while. So they actually do 100% match for her, which is awesome in her 401k. So, and she has that in a 70% stock, 30% bond account, but she's still a ways away from retiring. She is saving up for a home remodel. So every month she puts $1,500 in that, and it's in a cautious portfolio. So 50% stocks and 50% bonds. And then whatever is left after that, she's saving up for wealth building. Because she doesn't know when she's going to use it, she has it in a more cautious portfolio. So a 60% stock and 40% bond. So in summary of this, and thank you so much for joining me, is why do we invest? We invest as a way to build wealth and compound returns over time. It is a way of saving for money, saving for the place when we want to stop working, and to avoid having our money lose value to inflation. People really like investing in stocks and bonds, and they're a strong option because we really like investing in stocks and bonds. You get returns from dividends, and they have so much momentum behind them that it's a really safe place, at least historically, to be putting your money. Smart investing, how to do that is really simple. The things that you should do to set it and forget it: invest with the market, which will diversify you as much as possible. Automate your contributions, max out your retirement accounts, and as you're getting closer to the time when you want the money, make sure that you're becoming more conservative with it. And then overall, have a simple monthly plan of where the flows are of money, and then don't worry about it. So if you thought that this was interesting and you want to learn more, we, as I said at Carbon Collective, and as I showed you, we focus a lot on how to be a sustainable investor. And so in this presentation, how to be a smart investor who cares about climate change, I walk through some of these same principles, but really going into much more depth of what is the landscape that is out there in terms of how to invest in climate change and how do you apply these smart investment principles to them. We also are about to host a campaign on 401ks. So as we talked about, keeping your old 401k could charge you a lot in fees and you can lose a lot of money over time. The problem is that transferring is complicated. You have to call the old person who holds your 401k. You have to have all your account numbers correct. There's a lot of details to look out for. And so we're making it super simple to do all of the hard work with us. All you have to do is set up one call with us. We'll ask you every question that needs to get asked. We'll get all the information in one place, and then we'll call your provider for you. All you have to do is be on standby to verify and authorize the transfer. And then we're actually hosting in the month of September only, that for every 10K that you transfer over, we'll actually send you a bonus, and it's up to $25. So if you have 100 401k or IRA, not only will we make it really easy to get it and do the smart investing thing of moving it into an IRA and saving on those fees, but we'll actually get a big bonus in the mail for doing it. So with that, it's always important to remind you that past performance does not guarantee future results in investing or really in anything in life. So with that, I so appreciate you spending the time with me. And if you have any questions, feel free to email me at zach@carboncollective.co.